Everyone thought pets.com was the future. They were selling dog food online. What could go wrong? The year was 1999. The internet was a wild west, a digital gold rush where venture capitalists threw money at anything with a .com suffix. Pets.com, with its adorable sock puppet mascot and the promise of home-delivered pet supplies, seemed like a sure bet. But beneath the surface, a financial catastrophe was brewing. This wasn't just another startup that failed. This was a symbol. Pets.com embodied the irrational exuberance, the dizzying heights of speculation, and the ultimate, brutal crash of the .com bubble. It became a cautionary tale etched into the annals of business history. The company launched in November 1998, backed by venture capital firm Hummer Winblad and, crucially, Amazon. Yes, Amazon. Jeff Bezos himself saw potential, investing $60 million and taking a significant stake. This endorsement alone gave Pets.com immense credibility. The idea itself wasn't entirely new. Catalog companies had been selling pet supplies for years. Pets.com just aimed to do it faster, easier, and with the undeniable allure of the internet. They promised convenience, competitive pricing, and a vast selection. But the pet supply business, especially online, presented unique challenges. Pet food, for instance, is heavy. It's bulky. Shipping costs could quickly eat into margins, especially when competing with brick-and-mortar stores where customers simply loaded bags into their own cars. Despite these logistical hurdles, the company pressed on. They hired a charismatic CEO, Julie Wainwright, a former executive from Berkeley Systems, known for its after-dark screensavers. She was tasked with turning a concept into a colossal online retailer. Their marketing strategy was aggressive. They knew they needed brand recognition in a crowded, noisy digital landscape. And so, the Pets.com sock puppet was born, a simple, charming character that would become the face of their brand. The puppet became a sensation. It starred in a Super Bowl Roman 34 commercial in 2000, singing about delivering pet food to your door. That ad alone cost millions, a staggering amount for a company still finding its footing. They spent heavily on advertising across all media, television, print, and online banners. The goal was to acquire customers at any cost. This was a common .com era philosophy: market share first, profitability sometime later. The IPO arrived in February 2000, at the very peak of the .com bubble. Shares opened at $11, soaring to $14 before settling. The company raised over $80 million, a substantial sum that fueled further expansion and, critically, more spending. At its peak, Pets.com had 320 employees, a state-of-the-art distribution center, and a brand name that was, at least superficially, well-known. They were fulfilling thousands of orders every day, a testament to their logistical efforts. But the underlying financials were dire. Pets.com was losing money on almost every single sale. The cost of acquiring a customer, combined with the heavy shipping expenses for bulky items, meant their gross margins were deeply negative. For every $100 in revenue, the company was reportedly spending $125. This wasn't a sustainable business model. It was a rapid burn rate, fueled by investor cash, with no clear path to profitability in sight. The .com bubble began to deflate in March 2000. The Nasdaq, home to many tech stocks, started its precipitous decline. Investor sentiment shifted dramatically from irrational optimism to brutal skepticism. Suddenly, the easy money vanished. Venture capitalists tightened their purse strings. The market no longer tolerated companies burning through cash without a clear path to generating actual earnings. Pets.com was caught in the crossfire. Their stock price plummeted. From an IPO high of $14, it cratered to mere pennies. The company's valuation, once in the hundreds of millions, evaporated almost overnight. The sock puppet's charm couldn't save them now. On November 7, 2000, less than 2 years after its launch and just 9 months after its IPO, Pets.com announced its closure. 300 employees were laid off. It was a swift, brutal end to a dream built on faulty economics. The assets were liquidated. The most famous asset, the sock puppet. It was sold to bar none, an online liquidator, for a mere $125,000, a pittance compared to the millions spent on its creation and promotion. Pets.com became a punchline, a symbol of everything wrong with the dot-com bubble, its name synonymous with reckless spending, unsustainable growth, and the illusion of value over substance, a stark reminder of market delusion. Yet the story isn't entirely one of unadulterated failure. The underlying concept of online pet supply delivery was sound, just ahead of its time. Chewy.com, launched years later, would eventually prove its viability, albeit with far greater operational efficiency and a more measured approach to growth. Pets.com was a puppet, dancing to the tune of investor hype. It demonstrated that even with significant funding and brand recognition, a flawed business model, coupled with a lack of profitability, is a recipe for disaster. Its collapse served as a brutal lesson for entrepreneurs and investors alike. Hype can create a momentary illusion of success, but only fundamental economic principles can sustain a business in the long run. The internet isn't a magic wand. Next, we unravel the rise and fall of Webvan, another dot-com giant that promised the world and delivered only debt.